Good afternoon, ladies and gentlemen, and a very warm welcome to this exclusive webinar. We are honored to have you join us today as we delve into the intricacies of navigating financial horizons in an ever-evolving global landscape. My name is Tencent Mudley. I am the Chief Executive Officer of Sanlam Private Wealth. During today's sessions, we'll explore strategies and insights to not only safeguard your wealth, but also to capitalize on some of the emerging opportunities. With the world facing unprecedented challenges and opportunities, it is crucial for us to stay informed and proactive in our financial endeavors. From geopolitical shifts to technological advancements, the world is experiencing rapid transformation. Reshaped economies and altered consumer trends pose unique challenges to the investment landscape. Yet despite these challenges, it has also unveiled new avenues of growth and innovation. In a year when more than 40% of the world's population go to the polls, geopolitical tensions continue to influence markets, posing both risks and opportunities for investors. With evolving trade policies and regulatory changes, it is imperative to navigate these complexities with diligence and foresight. With that, I hand you over to David Lurkey.
Good evening, everyone. Thank you for taking the time to join us today. Really, our question this evening is, can Goldilocks have her way in an environment that's not too hot, not too cold, but just right? Before we go into those sort of deep questions, I just want to remind all of our clients and prospective clients on the webinar this evening of our investment philosophy here at Sanlam Private Wealth. Many of you will have seen exactly this before many times, and that's on purpose. It's a reminder that our investment philosophy is our kind of true north that we always look to follow however the environment unfolds, so that we invest your money consistently. The first piece is price. Price is what you pay. Value is what you get. We always want to make sure that the price we pay for assets when we purchase them is less than the intrinsic value. And equally, when we sell assets, we want to make sure that the price is above our assessment of the intrinsic value of that asset. How do we know what the intrinsic value of that asset is? That's the middle piece, perspective. That defines our price levels correctly, tells us if things are cheap or expensive, and that, of course, is where the hardest work goes on within my team in terms of figuring out where we should be putting our clients' money. The final piece is pattern. We know that pattern regularly repeats. This is because stock markets and bond markets, all asset classes, are driven by the actions of human beings, and human beings are wired in a certain way that creates cycles. So we love to look at patterns of historical behavior, often gives us clues to how the future will unfold. A little bit more detail now on where we think our edge is relative to our competition. I think the first and most important is long-term thinking. We at Sanlam Private Wealth really pride ourselves on our ability to look after our clients with a long relationship over a long period of time, look after your money properly. And by being able to think long-term, we think that gives a healthy advantage over a lot of participants in the market who are extremely short-term focused. The next piece is detailed work. That's what helps us unearth quality, and particularly businesses with great sustainable competitive advantages that can carry on growing for an extended period of time. The third piece I touched on a bit earlier is understanding cycles. This, I think, is a fantastic advantage for us in the local market, but even more so offshore, because we're coming from South Africa. We as South Africans understand a more cyclical economy, and therefore we think we've got a little bit of edge there from understanding the global side. And finally, to put it all together, is one needs to have the stomach to make contrarian decisions. The stomach in March 2020, when the world was panicking, to instead of running away from the drama in markets that were crashing, but rather run towards those very attractively priced markets and buy assets at great prices, which then subsequently drive fantastic returns. So on a very high level, how do we like to think about stock picking? It's really, we want to think about quality and value. This statistics that you see on the screen here, these come from our friends at Schroders in the UK. really the point is we would all love to buy the highest quality businesses at attractive prices. That over time has certainly shown to be the best kind of returns one gets. However, the difficulty there is those opportunities come along quite seldom. So really for us, the sweet spot is in sort of market-like valuation, but high quality. We believe that the best quality businesses over time can give you excellent returns, and that you've got better scope for not just being successful in any given trade, but also that if you get it a bit wrong, which will happen to everyone over time, that if you get it wrong, it's less dramatically wrong than other times. Right, so when we think about your money, I think it's always healthy to remember that what we're trying to do here is make low-frequency decisions in a world where there's high-frequency data all the time. And we try not to get distracted by all the short-term noise, but rather make sure that we focus on the long term. So if I just start out having a look over the last 3 years, it's just sort of as short as we ever really like to look, what assets have achieved what. And as you can see sort of on the left-hand side, developed market equities certainly have done particularly well in rand terms over the last 3 years. And on the right, gold has also done quite well over the last while. Roughly towards the middle there, South African shares up around about 8% per year over the last 3 years. It's been a little bit of a depressed market. Even so, you have still comfortably beaten inflation over that period had you been in South African equities. And you can see sort of second from the left there, emerging markets have only done about 3% per year over the period. So we've beaten our emerging market peers in South Africa. We haven't beaten developed markets. That's why we make sure that for most of our clients, we have a portion of their wealth in offshore stocks as well. This just shows you some of the performance over an extended period of time. This is all the way back to 2005. Had you given us your money then and invested that money with us in our South African equity portfolio, that's your blue line there, over the last sort of 19 years or so, you would have increased your wealth by more than 8 times. Had you given the same money to one of our competitors, to our average competitor, you wouldn't even have increased your money by 5 times. And if in 2013 or 2014, you'd moved with us into a worldwide equity portfolio, which over time has increased its holdings in global stocks, that original 100 Rand would now be worth north of 900 Rand. Just showing you sort of how we've done over time there. Very happy to say that it's not just the very long term, but equally over 2 years, over 3 years, over 10 years, we are also in the top quartile relative to our peer group. So however long you've been with us, I think we can comfortably say we've looked after your money well. Similar scenario with our balanced portfolio, again, relative to the peers, comfortably ahead over an extended period of time. If I just take you and look just for a second within a South African equity context, we're quite excited. This is just showing our house view equity portfolio. If we look at that and we look 3 years forward, we would expect around about 16% earnings growth per year for the underlying businesses. And that compares to around about 12% for the South African market as a whole. And yet, as it shows you in the blue bars there, we're actually in our portfolio paying a lower multiple of those expected earnings than the market as a whole. So really, if you're with us right now, we expect to have faster growth than the wider market, and we're paying a lower price for that, which is really what we aim for. Just a reminder, there's been quite a lot of shocks in the world over the last few years. More recently just in the Middle East, but we've had many. A reminder that shocks are here to stay. Our task is not to predict the next shock, but rather to focus on resilience. And we must never fall for the myth of being victimized by the unprecedented. We know strange things will happen. We must always construct our clients' portfolios to make sure they can handle that and they are robust to multiple potential outcomes. So let's now go and have a look at a potential Goldilocks scenario in the US. What we've seen over the last year and a half or so, if you look at the blue bars there, is really the US economy has just grown a whole lot faster than the rest of the world. despite the fact that they've increased rates dramatically. So it all looks rather rosy in America. This time last year, a lot of the world was thinking that the US, like the UK or Germany, would be heading into recession by now, and yet the US remains remarkably strong. And if we have a look here, your black line there shows you the Fed funds rate. So that's the equivalent in America of the repo rate in South Africa. And really that interest rate has gone from essentially 0% to north of 5%. Despite that, as we saw on the previous picture, that economy continues to grow well, and they've managed to bring core inflation down from almost 7% now to under 4%. So they've brought the inflation down, and that interest rate has gone up dramatically, and it hasn't managed to hurt that economy yet. What we've also seen just in the last sort of 9 months or so is that inflation in the States is now below the rate of growth in wages. So that's very positive for your average American, who of course took a bit of strain sort of through 2021 and 22, where salaries weren't growing as quickly as inflation was. That is reversed now. That's quite positive for the average American. The one concern there is that the US Federal Reserve does view 3% wage growth as about consistent with their inflation target of 2%. So they do need to cool that a bit further to try to get inflation down to their 2% target. How on earth have these Americans managed not to have their economy slow down when they've increased their rates so much? It's because, among the many reasons, but probably the biggest, is that the Americans typically have fixed rate bonds on their homes. So while my bond and presumably yours will go up and down as the repo rate fluctuates, in the States you'll fix your bond for 20 or 30 years, so you're not impacted by the change in the price of money essentially. What you can see on the left-hand side there is therefore that in the UK, in Europe, the average bond rate, that's not a new bond, that's the average of the total environment. Those bonds have become more expensive, and therefore monetary policy is working. It's doing what it's supposed to do. It's essentially taking money out of people's pockets. By contrast, in the States, it's not really happening yet, and the same thing is happening for corporates, where in America, around about 60% of corporate debt is in fixed rate bonds. So again, those corporates aren't being hurt as much by the increased price of money as their peers in Europe would be. With all of this, we've got a healthy, strong American economy, and then we have a look at the budget deficit there. And it's quite remarkable to me. The budget deficit that the Americans are running right now is north of 6%. That's frankly crazy, given that their economy is so strong. So they continue to stimulate very aggressively from a fiscal perspective at a time they don't really need to. And that's also helped to create this current Goldilocks situation where the economy isn't being hurt by these higher rates. What we have seen so far this year is that the market at the beginning of this year was really expecting interest rates to come down in the States this year. What we've seen over the last few months is that expectation sort of fading away as people have realized this American economy is stronger than people previously expected. So let's have a look at markets now and some of the things that we can see. So firstly, in America, the S&P 500 has done very well, certainly over the last 6 months or so. That is now sitting around about 27% above its long-term trend. Now we know that from a valuation perspective, it maybe takes quite some time for valuation to play through in the stock market, but we are seeing that that US market is looking a little bit expensive right now. You can see it here maybe in a different way of showing it to you, that on the left-hand side, the S&P 500, that's the US market. You can see the blue dot. It's looking expensive on a price to earnings multiple basis relative to its own history. Equally sort of more towards the right, you can see India is also looking expensive. Where is it cheap right now? South Africa and China. Why? Because those are the economies that people are worried about. That's where you get your opportunities when everybody else is worried. What's fascinating to me right now is that the risk premium in equities is the lowest for many, many years. What does that mean? It means that what the equity markets are willing to pay you for taking the extra risk of holding stocks relative to bonds is low right now. So in history, as you can see in those dotted circles across the chart there, whenever there's been a wide gap between your earnings yield on the US market and what you can get from bonds, those were typically good times to be invested. Equally, when that blue section is lower, those have typically been less attractive times to be invested in US stocks. And right now, it's looking a little bit less attractive there. That doesn't mean we can't find specific opportunities, but it does mean at a broad level that US market isn't super exciting. That's kind of what this chart is showing you, is that if valuations revert roughly towards their long-term mean over the next few years, you can't expect a particularly exciting outcome from that US stock market. By contrast, if you use the same concept to look at the South African market, we're at a pretty cheap starting point. So from our local market, in Rand terms, we would probably expect to get double-digit Rand returns. 11% is probably our best guess per year over the next 3 years, maybe even a little bit better than that if the current bout of load shedding relief is sustained. If we then think and maybe move our heads in a different direction, let's think about bonds now. In bonds, what you're seeing on the screen here is the real return that you're being offered on inflation-linked bonds in the States. Currently, you're being offered around about 2% real. This is about as good as it's been since before the financial crisis. So US bonds actually looking quite attractive relative to their own history. 2% real return in dollars, not a bad place to park your cash if you believe you can trust the US government. On top of that, we think there's probably some scope for that US bond yield to come back down again. So, in our view, you should expect maybe 5 to 6% per year in dollar terms over the next 3 years out of any investment you may have in US government bonds. If we then move to gold, or a fascinating topic at the moment, don't have too much time to talk about it now, but what you can see on the chart is that if we think about the price of gold in real terms, adjusted for inflation, we're pretty close to all-time highs. This is in real terms. Obviously, we're at an all-time high in nominal terms, but in real terms, we're pretty close. Why is that? Because, as I showed you earlier, the US government is really spending quite a lot more money than they're earning, and frankly, so are the Europeans. So governments are spending too much. They have too much debt. Lovely statistic I heard this morning is that US government debt to GDP is now in north of 120%. Back in the 70s, when they had their nasty inflation the last time, it was at 30%. There's a very big difference in that. And what that means is it's more complicated for the US government to try to squeeze that economy properly to get inflation fully under control. Let's move now slightly different direction, back home here. Let's think a little bit about the elections in South Africa. So what I'm showing you here is our best guess with a little bit of help from our friends at Standard Bank Research. They're one of the various external providers we use to help us out with some of our research. And really, our best estimate is that the ANC in next month's election will get somewhere between 42 and 48% of the vote. DA probably around 20, EFF between 10 and 15. And the interesting one, second from the bottom of that first table there, is that we expect the MK party to be somewhere between 4 and 8%. Now, I know that we've seen some polls recently suggesting they'll get more than 10%. We disagree with that. We think that their ability to get people on the ground to polling stations on the day and vote for them is probably a little bit worse, and the ANC historically has shown very good ability to do that. But more important than exactly where we think the outcome is going to be for the election is what does this mean for your portfolio? So if in the middle, ANC gets somewhere in our base case scenario 42 to 48% of the vote, then they're probably going to have to make a coalition government with at least one mid-sized party. So that potentially means someone, probably the IFP, maybe even one or two small parties just to get them over the line. We think that will be positive for both South African stocks and South African government bonds. We think there's quite a lot of risk baked into markets right now of uncertainty about the election, and that's perfectly fair because we don't know what will happen. But our base case scenario suggests that if the ANC gets there, it's probably going to be positive for South African stocks and bonds. If the ANC gets below 42% of the vote, then there'll be many permutations firstly, but they will probably have to do a coalition with a larger party, be that the EFF, potentially MK. I don't think it will be them, but the market's worried that it'll be an EFF coalition. If that happens, it's negative for our stock market and it's negative for our bond market. You probably would also see Cyril Ramaphosa step aside and a more left-leaning president come into power. The next problem there is that a coalition would probably be unstable. I think everybody knows that, unfortunately, being involved in a coalition with someone like the EFF is going to lead to a lot of argument and discussion within government. And of course, the tragedy for South Africans under that potential scenario would be that the politicians would focus more on politics than actual service delivery. So that's why we see that one as negative. And actually, if the ANC gets above 48% of the vote, we think that provides a greater degree of certainty for the country, and that we would view as positive for markets here. South African bond yields, I touched on the American bond yields, giving you about 2% real yield earlier. South African bond yields are giving you around about 6% real yield. So you're being paid 4% per year extra above inflation for taking the risk of the South African government. And that's probably about fair, but we do think that post-election, some of that will calm, and so we do actually quite like the outlook for South African government bonds. At the moment, a 10-year bond yielding around about 12%. Even if that stays at around about 12%, obviously then you'll get about 12% out of your bonds over the next 3 years per year. If those bond yields come down a bit, you may be looking at 14, potentially even 15% per year as a kind of absolute return you could expect out of South African government bonds. So quite attractive for us at the moment, for those of you who utilize our more balanced portfolio solutions there. On that note, let's have a look at the portfolios. I'll start with the balanced portfolios. In our balanced portfolio, what you can see on the chart here is just how we've moved your money around over the last year. So you can see we've increased the alternative assets. We like to make use of one or two hedge funds in those Regulation 28 portfolios. We think that provides a fantastic risk-reward balance where we think you're not taking much extra risk in the specific type of hedge funds that we're utilizing there, but we do think there's some quite nice return available, and that allows us to take risks in other parts of the portfolio while keeping the overall portfolio risk at the right point. Something that you will probably see coming into your balanced portfolio, if you like that, if you're in one of those solutions at the moment, is some private credit. We found after a number of years of looking for exactly the right solution here, we found a private credit provider in the States. And essentially what do you get by going into private credit is you get more attractive returns out of corporate bonds. And you get that because there are wider credit spreads available in that American mid-market. What we also like is this is floating rate debt. And without getting too complicated, essentially this is more resilient type of credit to own in terms of its resilience to both inflation and higher interest rates. So if we get higher interest rates, which we don't see as sort of a definite scenario, but if that does happen, this is the kind of product that can give you equity-like returns with a lot of that sort of bond-type risk level, which we see as quite low. When we think about how we solve offshore equities, a very important thing for us is that our clients predominantly are based in South Africa. And most of our clients will have some of their wealth, or a large proportion of their wealth, in South Africa, and many will have a lot of that wealth in South African stocks. As you can see on the chart here, our local market tends to be a sort of cyclical value market, and therefore when we invest your money into offshore stocks, we want to make sure, A, that we are more defensive to counteract the cyclicality in our local market, and also we want to make sure we have some growth available to you. So you can see there the primary building block of our offshore solution. That's the global high quality strategy. That really solves the defensive part. And then for the growth part, to counteract essentially the lack of growth in the South African market, to counteract that, we use a bunch called Baillie Gifford, or for those of you in a direct portfolio, that'll be called Scottish Mortgage Trust in your portfolio. This is vaguely like a Remgro equivalent. They sit in Scotland. Fantastic long-term history of investing in fantastic growth businesses. So you can see within that little component of your portfolio where we focus on growth, that's the business that owns shares in NVIDIA, in ASML, which is also in the microchip space. They own things like Moderna, which is vaccines. You can see SpaceX there as well. We know that in South Africa, we don't have a great edge in finding the very best growth businesses worldwide. We think these folks at the Scottish Mortgage Trust, or Baillie Gifford, we think they have a fantastic, sort of beyond 100-year track record of investing in growth businesses. So we outsource a little bit of this to them to make sure that your portfolio is appropriately balanced and has that defensive quality and the growth quality to make sure it can grow over the long term. If we think about in our local equity portfolios, how do we break it up? At the moment, it's about 1/4 resources. It's about 20% in financials, mostly banks, which actually in South Africa we think are quite attractive investments at the moment. And then the big piece there, 35%, that's in offshore industrials. So that's where you'll see things like your Naspers, your Richemont, your British American Tobacco, and then you can see the rest of it there. Now compare and contrast that to our global equity holdings, where we've got pretty much 1/3 of it in technology and communication services. So communication services is just the strange name that the folks that categorize these things put businesses like Google in. But essentially, your first third there is IT and related technology type of businesses. Then the next piece, you can see 10% in consumer defensive, another 14% in healthcare. That's the defensive component of that portfolio construction, and you can see then the various other pieces around there. A decent amount in financial services. Where I would draw your attention, though, is while in the local portfolio or the local component of your portfolio, if you have a worldwide portfolio, the local financials will be pretty much all banks. That 13% that I show you on this picture on the international side is very, very little banks. It's much more businesses like Visa, which we think is probably the best inflation hedge business in the world. But that's kind of how we think about our offshore holdings. We do, thankfully, still have some time to talk about stock specifics, and I'll take you through some of the stocks that we think are the most interesting at the moment in terms of the actual underlying businesses. Just a reminder first, though, that if you mimic the herd, you're just going to get vanilla kind of returns. What we try to do is deliver our clients more interesting returns, and therefore our portfolios will look substantially different to the broader market. When I think about South Africa, though, just maybe a reminder that there's a number of factors that are already in place in the South African market. The market is fully aware that we have an election coming up. That the risk around that, we think, is largely baked into the prices in our market right now. Load shedding, the market is also fully aware that load shedding is a situation in South Africa. The market is fully aware of the underperforming state-owned enterprises, and the market is fully aware of our tight government budget situation. Those are things that are already priced into the South African market. So yes, they're things to worry about, but I don't think they are going to sort of have a fresh impact on our market beyond what they've already had. Because people know that they're there, so they're already priced for that. I think the first point I want to make around specific companies is to show you here how mining cost curves have steepened across different commodities. Why is this relevant? Because when we invest your money in resource businesses, in mining companies, we always want to make sure that we own the lowest cost producers, those in the first and second quartile of the cost curve. Why? Because those businesses tend to be far less volatile, and it also means at times of stress, they are more likely to be able to still make money throughout the cycle, so they can take advantage of opportunities when their competition essentially is just about going bankrupt. So we like our exposure to Anglo American, to BHP, and to Glencore. They're all in that bottom half of the cost curve. And particularly at the moment, we're quite excited about copper. We think that copper price has potentially some room to run. That's looking quite exciting. Each of Anglo's, BHP, and Glencore has around about a third of their business in copper, and we're not really paying a premium to hold those stocks at the moment. Gold I touched on earlier. This is just maybe one of the ways to think about it. So Anglo Gold, obviously, that's our choice for a gold mining stock. At the moment, gold price somewhere between $2,350 and $2,400 an ounce. Were the market fully pricing in the current gold price, your Anglo Gold shares should theoretically be trading at around about 580 Rand a share. At the moment, they're trading more to around 440 Rand a share, so the market isn't pricing in the current gold price. What we would just remind you, though, is that the gold price is extremely difficult to predict, but we believe that gold has a healthy role in any portfolio as a very strong hedge against inflation, and we certainly have seen that over the past few years. If I then talk about Tencent, a reminder, this is the primary piece of Naspers and Prosus. This is their key investment. It makes up more than 100% of the valuation of both Naspers and Prosus. And what you can see here, quite interestingly, just over the last 9 months or so, is that at Tencent, they've shifted their focus a little bit. They focused for a very long time on just growing revenue. They didn't really focus at all on monetizing their large user base. And we're seeing that now just in the last 9 months, where the profits have started to grow substantially ahead of the revenue base. That's because for many years, they under-monetized that user base, and we're quite excited at the moment. Certainly that share price looking very exciting the last few days. This is the largest component of our local portfolios, is in Naspers and Prosus. So obviously, we're very happy to see that taking place. Aspen here, this is one that's worked very nicely for us. We first got in some years ago at around 100 Rand. We trimmed substantially at about 270. We then added back last year at about 140, and then again at around about 165 in October. The point I want to make here is that when we added in late October last year at about 165 Rand a share, at that point, we weren't even paying for half of the promised new manufacturing capacity that Aspen had built over the preceding years. And really that was the main driver of our investment case, was Aspen spent a lot of capital building factories to manufacture drugs, but you as an investor weren't being asked to pay for that. Under our base case at the moment, we think Aspen's worth about 260 Rand a share. If management gets it correct as they sort of are planning and promising, in due course, we think Aspen's probably worth around 350 Rand a share if they manage to fill all of their manufacturing capacity. So we think this is quite an attractively priced share even now, despite the fact that it's run quite well over the last 6 months or so. Where if I shift now to a couple of businesses we like on the international side, the first one I'll talk about today is SAP. Remember, this is the leader in enterprise resource planning. Any large enterprise, SAP is really an enormous thing. It helps you plan your entire enterprise, and the key here is that every business that I've ever seen that gets an SAP system, they stay with that SAP system over time. Often it's very painful to implement for a business, but once it's working properly, SAP works fantastically. On top of that, you're seeing SAP transition their customers to the cloud, and that really gives them an opportunity to double or even triple their revenue from any given customer that does so. And now you're seeing actually the cloud revenue for SAP more essentially being a larger part of their business than just software and licenses. We think this is a business with a lot of room to grow. I spoke right at the beginning about quality. We think SAP is a great quality business. And remember, those customers are locked in, they're stuck. It's a fantastic sort of sustainable competitive advantage that we think SAP has there, and we think the price of the share, although it's gone up a long way, we still think there's some healthy upside here. If I then shift to something maybe a little bit newer in your portfolios, those of you who have offshore portfolios with us will have seen United Healthcare come in. This is the leading health insurer in the United States. Now remember, the US has a different environment to South Africa. Here we have a medical aid, which is essentially a non-profit, and then Discovery, for example, makes profits as an administrator. The US system is that it is medical insurance, and therefore it's an insurance type business. But what you can see in the blue there is the way the earnings here have grown over time. That's since over the last 10 years, United Healthcare's profits have grown at about 17% per year annualized. Management there are guiding for 13 to 16% growth in profits over the next 3 years or even longer. And we think, yes, you're paying nearly 20 times earnings at the moment to buy this share, but we do think it is a very, very attractive business. And you've been given a little bit of an opportunity because there's a US election later this year. Typically, around election time, healthcare businesses take a bit of strain in their share prices, provides you great opportunity to be in a long-term growing business in a large economy. Then something else, there's a lot of talk around AI in the world for more than a year now, and really our exposure to AI doesn't just come via our ownership of shares like Google and Microsoft, which have fantastic AI exposure themselves, but also through something like TSMC, that's Taiwan Semiconductor. This is by far the largest maker of microchips in the world. So something like NVIDIA, you can see on the screen there, they are a designer of microchips, and then they put that together to make graphics cards, whereas TSMC are actually the ones that build the microchip. And they are by far the largest in the world. They've kind of dominated Intel to such an extent that Intel doesn't actually make their own chips anymore, certainly not at the leading edge. We think this Taiwan Semiconductor is a great balance in terms of getting AI exposure, but at a reasonable price and without the potential risk associated with something like an NVIDIA, which is very much flavor of the year right now because of the graphics cards that they produce. But we think they're making too much margin there at NVIDIA, whereas we think Taiwan Semiconductor's profit level is sustainable, and we think it can grow very nicely, more than 20% per year over the next few years. If I just take a step backwards a little bit, maybe help you understand who makes money where and how with AI, your starting point is the hardware. Think about that in a gold rush context. That would be the guys providing the spades to dig up the gold. So that's Taiwan Semiconductor. The next piece is cloud and infrastructure players. How do you see that in your portfolios? Through the holdings in Prosus, through the holdings in Microsoft, through Google, and through Alibaba, which of course is also in China. Then it's those companies that do the models, these AI models, and will on top of that put the algorithms. Again, it's the same for Prosus, Microsoft, Google, and Alibaba, where you make money in your portfolio out of that. And then the final piece is application software. So if you think back to the beginning of the internet era, that was essentially before Facebook had even been invented. That's the application software. We're early in the AI journey right now. We think that the very best Opportunities will come from that space, but the application software is also where we think we've got the least visibility. That's where we take advantage, as I touched on earlier, of the folks at Baillie Gifford to really find us the most exciting growth opportunities. A lot of them won't even be listed. So those folks will go and find those fantastic opportunities for us there, and we make sure that's the correct size within your portfolio. So to conclude today, I think I'd like to just give you a few words. Firstly, the US economy looking very resilient at the moment. But do note that we're not out of the woods yet, that inflation is not back down to target. It looks fantastic right now, but we're not there quite yet. We are seeing that US stock market showing some signs of complacency. I think the market is probably a little bit too optimistic on economic growth, and we see that in valuation. By contrast, in South Africa, our structural growth issues, I think, are very evident in our stock market pricing. And do remember that SA is subject to the global cycle. So what will we continue to do? We'll continue to make sure that your portfolio is robust to a variety of potential outcomes. We want to make sure that whatever happens, your portfolio doesn't lose much money, but is able to benefit from the changes in the world. And underlying all of that is we want to always focus on buying quality businesses at attractive valuations, and that we think is still the very best way to build long-term wealth for our clients. Thank you, everyone. I think I'm going to hand over now to Thiessen to maybe take us through some questions.
Thank you very much, Dave. I'm going to start with an interesting one. Surely an exciting time to be CIO of one of the largest private client asset managers in the country. How do you enjoy that space?
I love it. My wife laughs at me because I go to bed late at night and get up early in the morning, and I get very excited about my job. This is what I do in my heart, not just what I do for a living. I love the fact that there's something new to learn every day, and that I have to make sure I understand all the different pieces of the world and how they fit together. So I think we all want to learn a lot while we're doing our job. And there's a fantastic sense of satisfaction also in managing our clients' money to make sure that people's savings today can be worth a lot more in future in real terms. So yeah, I get very excited.
Quite an important task at that. What keeps you up at night?
What keeps me up at night, I worry about, are we doing the very best thing for our clients, managing that risk versus reward perfectly? One can never do it perfectly, but are we managing it correctly? I suppose what's really keeping me up at night at the moment is in the States and in the rest of the developed world, there's too much debt on government balance sheets. That's the one thing that worries me. That's why I want to have some gold in all of our client portfolios, because I worry that maybe the world loses faith in all these governments overspending. That's probably at a high level what keeps me up at night. At a more micro level, what keeps me up, I suppose, is wondering if any given business we own might do something stupid tomorrow. But that's, I suppose, par for the course.
Absolutely, absolutely. So just a reminder to all of the attendees to use the Q&A function. There are some questions that are coming through, so I'm going to jump straight into them. So Dave, let's talk about a specific share. Let's talk about Richemont. What is SPW's views on Richemont?
Right. It's a business that we love. We really like the business at Richemont. We think the valuation at the moment is reasonably close to fair. We think our fair value is sort of around about 2,700 Rand per share. So we're not far away from fair value right now. But this is a business we like because I think they've got these fantastic brands that are essentially non-replicable globally. These brands can't be replicated. It takes 100 years to build a 100-year history for your brand. And we think that gives them a good, strong runway for growth over an extended period of time.
Excellent, thank you. Bit of a tough one now.
Yeah.
So let's talk performance. Obviously, we're in the business of performance. That's what keeps our clients with us. The performance, SPW's performance hasn't been great over the last year. What are the reasons for this? And probably this is the more important question is, What are you doing to change that?
Right. Thiessen, I think the first point I'd make there is 1 year performance. Of course, it's relevant, but remember, we try to manage our clients' money over decades. And what I would point out is that we had a fantastic 2021, a fantastic 2022. We gave a little bit of that back in 2023, but over the last 2 years, over the last 3 years, we're very much in the top quartile of our peer group in terms of our performance. Really, what happened last year, we were maybe a little bit too defensive in our positioning. We wanted to make sure that our clients didn't lose money last year. And global equities actually had a very good year last year. So they were a little bit more buoyant. In terms of what's going to change, it may sound weird to you, but actually very little. That's why I started today talking about our investment philosophy. That philosophy has worked beautifully over an extended period of time, 10 years, 15 years, very clearly in the top quartile of our peer group in terms of performance. And that philosophy has worked well for us. And I would expect it to continue to do so. Obviously, we evolve our processes to make sure that we can predict the future as perfectly as possible, but the philosophy remains the same. We continue, though, to sort of improve our tools and improve our knowledge. What I would say is that, utilizing fresh tools, I touched on some of the hedge fund part that we're utilizing, some of those tools in the balanced portfolios. I think that's among the things that we do to try and reduce risk while retaining returns. So I think that provides our clients with a smoother ride, which I think is very good for everybody else's ability to sleep at night.
So a lot of questions coming through around crypto. So I'm going to try and sort of lump them together. So sort of one is how does SPW view crypto and its inclusion in our portfolios? And then the second one, maybe adding on to that, have we considered using crypto ETFs? Your views?
So we've considered these things for many, many years. I remember I wrote an article back, I think in 2016. Bitcoin was all of $2,500. And so this is something I've been thinking about for, 8 years now. Thinking deeply, trying to understand. And for us, our thought process is that we cannot ascribe a value to a cryptocurrency. If I buy shares in, for example, to use your example, Richemont, that is a growing business that creates value. All right. So if I buy and hold my Richemont shares, over time I will earn money via dividends. By contrast, if I buy a Bitcoin today, and I hold my Bitcoin today, and I sell it in 10 years' time, the only way I make money is if somebody else is willing to pay more for it than I am. Now, really, we think gold does a better job of protecting you in a difficult situation, in, say, an inflationary environment or something. We continue to assess crypto to try and find a way that we can philosophically understand the role it would play in a client portfolio. I think as an asset class, though, it is just too fresh. We've seen huge swings in crypto over the last number of years. I mean, up 100%, down 50%, back to kind of where it started. In terms of the ETFs that you asked about, we won't at this point put cryptocurrency ETFs in our model portfolios for clients. A, because, as I said, we can't value it properly, and B, because we definitely don't think it is the right asset for everyone. It can be for certain people. If you have the right risk tolerance, speak to your portfolio manager and say you'd like to buy a cryptocurrency ETF. Your portfolio manager can certainly help you out with that. We don't recommend it, but we are certainly able to help you out there.
Great. We are running short on time, so I'm going to push you for some quick answers.
Sure.
How often do you make asset allocation shifts?
Sometimes, seldom, sometimes every month. If I average it over, say, the last decade, we'll make subtle asset allocation shifts probably every 4 to 6 months, and maybe every 5 years we'll make a chunky asset allocation shift. But it very much depends on markets.
Great. Denton Wilmot, an advisor out in the southern sort of Eastern Cape. How will Tencent be affected by the economic downturn in China?
I think it's already been impacted by that. You certainly saw
I think it's priced in already.
Definitely, yes. Over the last couple of years, that Tencent share price in Hong Kong dollars hasn't done particularly well, yet the underlying business has continued to grow its profits, as I showed earlier. So, I think that's all baked in, and if anything, China is at a different point of the economic cycle. We think they're at a point where they've kind of been through their pain, and they're more likely to now move into a bit of an upswing. So I'm quite excited about Tencent.
Great. Interesting one. What is your local and offshore stock pick for the rest of 2024?
Right. Local, I'll give you two. One, I'll say Aspen, which I touched on, and the other one would be Prosus, which essentially talks to Tencent. Offshore, let me give you two as well. I touched on Taiwan Semiconductor. Yes. Another one that we find very interesting that we just added to portfolios the other day is Hilton Hotels. That one, maybe I'll just take 30 seconds if you don't mind.
Yeah, let's go.
What I love about Hilton Hotels is they own the brand, but they don't own the building. So they don't have this giant capital drag to build new hotels wherever they build them in the world. But they've got a pipeline over the next, I think, 6 years or so to grow the total number of rooms by north of 40%. So they can grow their business by north of 40%, but they don't have to put down the capital to build the underlying hotels. So they make phenomenal returns on capital. They own the brand, but they don't have to reinvest so much capital. If you think of a manufacturing business, if a manufacturing company wants to grow, they have to build a new factory. Hilton essentially outsources the building of the factory, and they just own the brand. Lovely, lovely business that I like there.
Great, thank you. Two questions around sort of performance. The one talks to peer group performance. Is that the right metrics to focus on? If you're focusing on a 10-year period, how does it compare to the MSCI, ACWI, and the JSE index? And maybe the second question is, how does our performance look if measured against a US dollar index? ZAR is being devalued. We know that. It's not what I want to be measured against. This is obviously the individual that made that comment. I want you to hedge that and ensure that it against inflation in a US dollar index.
Right, so just make sure I answer all the different pieces there. What I would say is against our benchmark, as I showed at the beginning, over 18, 19 years, comfortably ahead of our benchmark in our local equity portfolio. In the pure offshore equity, we've lagged that benchmark a little bit. We made some changes towards the latter part of last year around how we structure the makeup of our offshore equities. Essentially, when we sort of up until about 2020, our offshore equities had comfortably outperformed their benchmark. The way those offshore equities were positioned in the subsequent few years maybe didn't work out. 2021 particularly was a difficult year there, caused that to drag. We're quite comfortable, though, that we've got the right mix of different offshore equity components to deliver correctly there. In terms of a balanced portfolio, there's not really a proper benchmark. There, the peer group would be your only realistic benchmark, and in our balanced portfolios over multiple time periods, we are in the top quartile relative to those peers in the various buckets. Then to the question around should we compare to offshore? And the answer there is, if you would like your money to be managed relative to a global environment, 100% happy, just make sure that you give us a mandate to manage your money on a global basis. Be careful. If we have a mandate from a client that says they want to be invested in, say, a local equity portfolio, then obviously we can't own Google because it's a local equity portfolio. If we have a worldwide mandate that's at the moment around about 60 SA, 40 offshore, then we'll manage to that benchmark. And if you give us a mandate to manage pure global, then we will manage your money against a dollar-based pure offshore benchmark. And we can do that on an equity basis or on a balanced mandate kind of basis. So, yeah.
Great. I'm going to try and squeeze two more in quickly.
Sure thing.
Your take on Sibanye Stillwater.
Sibanye Stillwater, interesting business, not for us I touched earlier, we want to own mining companies that are close to the bottom of the cost curve. Sibanye Stillwater, much higher on the cost curve. That means it's got more leverage either way. If things go well, if prices of gold and more importantly platinum go up, more leverage there. Equally, if it goes down, bad. We prefer to hold Northam, bottom of the cost curve, less risk, and able to make money throughout the cycle.
Excellent. Thank you. One last question. How do you account for China's regulation risks?
You pay a lower price for those assets. So you'll notice, Tencent we're excited about. Tencent, if you strip out some of its investments in things like Spotify, for example, its various investments, Tencent's only trading at 10 times next year's profits. Microsoft's trading at 30 times next year's profits. If Tencent starts to trade at 20 times next year's profits, we'll say, whoa. And that difference between the 20 and the 30 is essentially how we sort of make sure we don't overpay for that Chinese risk.
Excellent. Thank you. David, thank you for your insights. Ladies and gentlemen, as we conclude today's webinar, we extend to you our gratitude firstly for your attendance, but also for your participation and engagement. As we navigate the ever-changing landscape together, rest assured that our dedicated team stands ready to support you in achieving your financial goals. Thank you for joining us this afternoon, and we look forward to continuing this journey with you. Thank you.